The traders are answering your questions. First up, a question for Joe from David in Baltimore. American Express can't seem to break through 120. Should I hold?
Yeah, I think you can hold American Express. I am out of American Express back in 2017, right around the $85, $90 level. I got into American Express. I used it at that time as an alternative to the underperformance from the big banks. I wasn't excited about the big banks at the time. Again, in 18, I traded around. It gets back to 85, 90. That's the spot that you love to get in. I think it's okay to hold it here. I am not in it because I'm finding opportunities in U.S. Bank and Wells Fargo and J.P. Morgan. So I've allocated the money there while American Express is basically kind of treading water, running in place. July of 2019 was the high up at 129. You're seeing a little bit of slower corporate spending, a little bit slower loan growth. That's why it's running in place. But I think it'll accelerate once again at some point.
All right. This one's for Dr. J. Danny in Belgium, international viewer, wants to know if he should hold Chewy through its earnings report in December or write calls. What do you tell him?
I would write calls, Mel, but I'm comfortable holding the stock. I own call spreads, full disclosure, in Chewy. Earnings are going to be December 9th. I think they'll be strong. But just in case, I have a call spread rather than owning the stock, Mel. So I'm happier with that, taking a little leverage into play rather than just having the stock naked.
All right. This one's for Jenny. Tom in Florida asks, what are your top 3 favorite stocks in your portfolio?
So this is really hard. It's like asking me to choose my favorite child, and I had to narrow it down, but I did choose 3. So what I'm basing this on is the ability of these companies to deliver a dividend no matter what happens in the economy. So the dividends are super, super, super safe. The valuations are low. They're immune to market noise, and they don't have that analyst or activist community coming after them. So my 3 tops would be Dow Chemical, which has a 5% dividend yield, Enterprise Products, which has a 7% dividend yield, and the last one is Compass Diversified Trust, which is a publicly traded private equity firm with phenomenal companies in it, and that's got about a 6% dividend yield.
You didn't mention projected return.
Oh, so, okay, so that's a good one. So I think the majority of the return will come from the dividend yield on these, and then I think that there's a little bit of upside and capital appreciation on the stock, but I'm not looking for huge capital appreciation. Maybe like GDP plus like growth. So, you know, if I'm hoping for a decent return next year, expecting that we're not going to have another 2019, and I think maybe, hey, we'll get lucky if the market returns 8 to 10%, I think these could all keep up with that between capital appreciation and the dividend.
All right. And the final one is for Weiss. Marty on Twitter asks, does Stephen Weiss have an exit point in mind for Cloudera?
So my exit point is a lot higher than where it is. So you've got Carl Icahn involved. You've got relatively, I'd say, new management and a turnaround in the work. So it's been decimated since the IPO. It's been a great gainer. I actually bought some more at lower prices recently, just in the last week. But I think that Carl gets a company sold at some point. If not, the fundamentals will improve. We already had a better quarter last quarter. So I don't have a price target off that's what's being asked, but I think it's going to continue to trend up. But it's also not a core position. This is more in the speculative bucket. I'm not putting my kids in this.
Right. Okay.
You're putting your nephews in it?
I'm putting your nephew in.